Jason, I spend a lot of time with community banks across the country talking to them about their lending needs, what they're thinking in terms of risk appetites, and in particular, they spend a lot of time on real estate loans and a little bit less on commercial and industrial loans. Historically, that seems to have been the trend. From your perspective, as someone who's had a lot of experience in both the real estate and commercial lending space, can you just talk a little bit about your background so we understand how your experience really informs your decisions with respect to C&I lending?
Sure. I've been in the lending space for over 30 years. I started by advising banks and thrifts on their balance sheets, and for the last 20 plus years I've been investing as a direct lender. And in 2000 started a commercial finance company where we would lend to the middle market and literally made thousands of loans to companies.
Most of my experience has involved discussions around real estate lending. So one of the interesting things for me has been understanding the differences between how one would look at a commercial and industrial loan versus a real estate loan. And Jason, since you've actually had experience making loans in both sectors, I'm curious as to how you consider the differences from a perspective of a credit committee member.
It's very simple to me. Both commercial and industrial loans and real estate loans are ultimately about the underlying cash flows that are generated. With C&I loans, you're looking at the cash flows that are generated by selling the services or products of the companies that are generating them. With real estate, you're looking basically at rent cash flows. So that's the basic similarities. After that, they diverge a lot. So with companies, you're looking at the viability of the company, you're looking at the management, you're looking at a variety of different intangible components of the loan. In contrast, in real estate, you're really looking at a tangible asset, and you can measure that much more simply. You can measure that on what it would cost to replace that asset. You could look at what it would cost to buy a standing asset today. And you can probably have a better sense of what your rents will be today and at least into the near future, and what the rents have been over the life of a given area. Because it's, again, a very locally based underwriting. So I would say at the end of the day, real estate loans are easier to underwrite, and they are in a more defined range. And company loans take a little bit more underwriting experience.
One of the things I find the most interesting about our credit committee is that it seems like when we first consider a loan, there's often a very immediate visceral reaction as to why this is or isn't a good loan. And from your perspective, what drives that reaction?
Well, my first response to that is, do I understand what the company does by reading the memo? If I don't understand it, then I try to understand it. If I still can't, then perhaps the company is a little too complicated for us to look at. Oftentimes I will understand it, and then it's just a question of then looking at a variety of factors, looking at the quality of the management, looking at how they've grown their business, what their likelihood is of consistent cash flow over time. I also look very closely at the capital structure. I want to make sure that the equity is truly at risk and that the senior debt, which is what we look at, is really not at risk. Because if you look at a loan, there's really limited upside anytime that you lend to a company. You get your interest rate and you get your money back, and you want to make sure you get your money back. So if there's ever a case where it looks like you're getting your money back and your coupon is at risk, it's better to shy away from that loan than to move forward.
One of the things I've often found in credit committee is there can be an immediate response, but then also as we discuss a business, there might be something that sounds like a good business where we understand the story, but there's a reason that you don't think it's a good credit. And what drives that response? Are there certain industries that, as a rule, you would just tend to avoid, or are there certain credit profiles that make you nervous? What are what would be an immediate deal breaker?
There are a couple of things that I consider pretty quick deal breakers. I don't like to be completely dogmatic about specific industries or whether there are sufficient covenant packages. You really have to look at the whole picture. But there are a couple of things that really do stand out. One, again, is capital at risk. You really want to make sure that you're not in a situation where the debt is at risk, so that you're giving as a multiple of cash flow a amount of debt that would be more than the company could be worth in any appreciable circumstance or understandable circumstance. Another thing is, can the business be impacted by things beyond its control that could either dramatically change the valuation or put the company out of business altogether? If that is a situation that might exist, again, it seems to me that it's a pretty quick deal breaker. So a bad capitalization and a business model where you don't have control over your destiny.
So I know that last year in 2012 we had a great year and saw a lot of high quality loans that have had covenants and had stories that make sense. I'm just curious, sort of what are your expectations for the loans that we might see in this year in 2013?
Well, 2012 was an interesting year because we did see a lot of high quality loans that came with good covenant packages and very nice yields. And when we talk about yields, we're looking at spreads over LIBOR and with LIBOR floors, so that the payment to the lender was oftentimes north of 6%, which is attractive in this environment where the cost of funds is less than 1%. What we saw over the course of the year are two things. One is, which is a natural ebb and flow, which is there are times where supply came on strong, and when it did, that yields actually became even more attractive. Towards the end of the year, we saw some real tightening, and that's really because of the Federal Reserve actions that have flooded the market with liquidity. People are looking for attractive places to put their money, and unfortunately, non-traditional investors have found the lending space to be an attractive place to invest on a relative basis. I think we're going to continue to see in 2013 a flood of money into the sector that we focus on. That will change when the Fed's policy begins to change. It'll change when rates start to rise and people get scared because we are a real safe haven from a credit standpoint. So I think we'll see generally tighter spreads, perhaps some weakening in the credit standards, and so we'll just have to pick our spots much more carefully.